Exactly. So I mean, in a lot of systems, whoever leads the country also has control of their legislature. Whereas here, we often have a divided government. So in many ways, the United States president is actually one of the weakest leaders, relative to all the different parts of government that operate.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today, a new guest, Lyn Alden from Lyn Alden Investment Strategy. Lyn, thank you so much for joining us today.
I'm glad to be here. Thanks for having me.
Awesome. Now, we've had a pretty crazy couple days with the election. Election night, it seemed like Trump was going to win, and then it flipped overnight. It looks like we're headed towards a Biden presidency. We're recording this Friday. We're still, it's not 100% set in stone, but that's what it's really looking like. Now, what's interesting is that the stock market reacted positively to this, and a lot of people are thinking, okay, what's going on here? You actually kind of predicted that the more important thing is not necessarily who wins the presidency, but whether we're having a divided government, whether there's a Republican Senate. So what do you make of what's happening right now in the stock market and how it's reacting to the election results?
Yeah, sure. I mean, we had a couple kind of cross currents. So if you look, kind of in real time, what was happening election night, at first, at the very beginning, it looked like there might be a blue sweep happening. And so you started to see treasury yields go up pretty rapidly. And so we started to price that in. However, on election night, we started to see that, Trump was pulling ahead. And we saw a very sharp move down in treasury yields. But then, of course, Wednesday, morning, it started to look again like Biden was going to win. But that the blue sweep outcome was probably off the table. That the Republicans would probably maintain control of the Senate. And so we started to see kind of a mix of outcomes. So we saw a very strong rally in healthcare stocks. And so this is, something I've been covering for a little while, that, many healthcare stocks are actually pretty attractively valued. But they have, of course, the existential political risk of healthcare reform. And that was substantially de-risked actually back when Joe Biden won the nomination over Bernie Sanders, because neither Trump nor Biden are particularly aggressive towards healthcare stocks. And that was even further de-risked if indeed Republicans maintain control of the Senate, because it basically means no major healthcare reform is likely in the next couple of years. So we saw a very sharp rally in healthcare stocks, and I think it's fully justified. I think many of them are still attractive. We also saw a rally in tech stocks, which could be interpreted a few different ways. One is, so with a mild decline in treasury yields, that's good for very long duration growth stocks. So all else being equal, that pushes up their valuation a little bit. It also probably reduces the chance of antitrust activity against them. So we've seen, for example, the House, pass some measures to potentially look into some antitrust activity against some of the big tech stocks. But with the red Senate, it's a little bit more mixed. It kind of took a little bit of pressure off them a little bit. And we've seen kind of mixed outcomes in the more value stock space. We also initially saw a dollar spike, and then we've since seen somewhat of a dollar pullback. So we've seen a couple different outcomes. And I think going forward, what seems to be the case is, we have a divided government most likely. Now, there's still a little bit of a curveball with the Georgia Senate runoff situation. So there's, technically the Democrats still have a narrow path that they could potentially take the Senate. So it's not fully off the table. But at the current time, the market seems to be pricing in a Biden win with a red Senate, which means kind of the status quo continues. We've also seen remarks from McConnell about making a stimulus bill a high priority here in the lame duck session. And so, he struck somewhat of a more, compromising tone. So we'll see if they can pass some sort of targeted bill or not. So I think markets are kind of pricing in multiple things. And of course, we also had a Fed meeting, 2 days after the election. So they basically reaffirmed that they're going to remain very accommodative and keep rates locked super low for a while.
Definitely. And before the election, you wrote an article about how about the election and the importance of the president. You say in the article that we tend to think of political history in terms of who was president, because we can put a face and a general political tone to that era. But congressional control plays a big part as well. So can you kind of elaborate on that? Really, how maybe the president isn't actually as important with respect to the economy and the markets as a lot of people think.
Exactly. So I mean, in a lot of systems, whoever leads the country also has control of their legislature. Whereas here, we often have a divided government. So in many ways, the United States president is actually one of the weakest leaders, relative to all the different parts of government that operate. And an example of that was the Obama administration, where he couldn't get much through outside of his first 2 years. And even in his first 2 years, when he had 60 Democratic senators, he had to strip the public option out of Obamacare because he couldn't even get every single Democratic senator to override a filibuster. So it shows how much kind of consensus they need to make any sort of major change, whether people agree with it or not. Basically, the process kind of inclined towards maintaining the status quo. And of course, for the next 6 years of the Obama presidency, he was up against a red Senate, and basically just had constant degrees of gridlock. And a lot of the changes were made from previous things just expiring with no kind of agreement to kind of change anything. And so going forward, if we have that similar situation where we have Biden as president and we have McConnell leading the Senate, you're likely to see basically a lot of gridlock, at least for the next 2 years. We'll see what happens with the midterm elections, but then potentially for the full 4-year term that we have. So, it's really about kind of seeing whether or not there's any sort of wave, like a blue wave or a red wave, that can potentially usher in a very large change in the way things are structured, versus just seeing more of the kind of the same situation playing out. And right now we're in kind of that latter situation.
No, I know a big part of the campaign, at least on the Trump side, was saying that if Biden got in, we'd have shutdowns again and all of that. What is your perspective on that? Do you think that is a big possibility that we could see shutdowns, with the Biden presidency and coronavirus, coronavirus numbers going higher now?
I don't see it as a significant possibility. It's certainly a higher possibility than if Trump was in office. But there's a couple of things to consider. So one is, if you look at the previous round of shutdowns, almost all of that was state and local driven, right? So states and localities decided to shut things down. And we saw that kind of rolling over time. So whenever a state or a city had their hospital systems overwhelmed, that was kind of the big trigger point for them to start kind of tightening down on restaurants and things like that. And so we haven't really had that much kind of top level downward direction on, whether it relates to masks, whether it relates to shutdowns. Now, Biden has been a little bit more mixed on that. He said basically he would listen to experts. So, we'll see what that means in 2021. But so far it's kind of mixed evidence that even does a whole lot, shutdowns in particular. So, for example, we look at the Asian economies. Many of them have been they've been through pandemics before in the past, right? So the public's very oriented towards them. The government has experience with it, with tracing it. And so they've basically been able to do very kind of narrow shutdowns on high risk areas like, bars or things like that, while going about normal business with some precautions like masks and other form of social distancing. Here in the U.S., we have less experience with this. And it's going to, remain to be seen. There's not really, necessarily a ton that the federal government can do in terms of forcing kind of countrywide lockdowns. It's mostly a state and local decision, but there might be more top-down pressure under a Biden presidency if the pandemic gets worse. So far, we've seen, we're currently in the third wave of cases here in the U.S., the third wave of hospitalizations, but each time the death rate gets a little bit lower, and I think that's combination of we're getting better at treating it. Our most vulnerable populations are kind of more protected from it. And I'm not a medical expert, but our immune systems are, these things kind of, as they distribute through a population, they generally get weaker over time. We adapt to them. So as we go deeper into 2021, I wouldn't expect kind of a full kind of March and April like lockdown happening again. But we have seen kind of parts of that happening a little bit in Europe.
Definitely. It does seem like the stock market's reaction to all of this and a Biden win doesn't seem like there's a big possibility of further shutdowns. It seems like if that was a big possibility, then we probably wouldn't see stocks rising.
Probably. I mean, we have seen more outperformance from the tech stocks, and so they're the ones that are more resistant to, or even in some cases, benefiting from lockdowns. So I think the market's been a little bit kind of cautious. We haven't been like, for example, piling into value stocks or cyclical stocks in the past couple of days. A lot of the rally's been in the tech stocks. Initially we saw kind of a gold stock sell-off, but we've seen kind of a rebound in gold stocks. So we haven't seen really a strong move in the cyclical stocks that actually would be more impacted by a potential shutdown. So I think the market is very unclear. They're kind of balancing stimulus, they're balancing lockdown potential, all sorts of things like that.
Getting into the gold market, if you wanted to share a bit about that, we saw quite a rise in gold on Thursday. What is your perspective on gold's reaction to all that's been happening?
So gold, it responds to a couple different things. I mean, one is real interest rates. And so, basically this summer we saw kind of a bottoming out of real interest rates. We saw, inflation expectations kept rising while nominal yields were very low. So we had a deeply negative, more than 1% negative real interest rate. And that was very good for precious metals. Ever since then, we saw kind of a retracement in inflation expectations. So a slightly reduced, expectations for stimulus, going into the election, and then, now that we have a divided situation, we'll see what happens. So gold's been kind of in this kind of, neutral zone of knowing that, real yields are still negative. We're still seeing, pretty rapid increases in the broad money supply. We're still running very large deficits. We have kind of a global kind of currency devaluation happening, but at a much slower pace than we saw in the first half of this year. So I think we've seen a pretty good correction here, and some of the kind of frothy sentiment was taken out. So I remain kind of long-term favorable towards precious metals, even though I don't have a particularly strong opinion over the next, call it 3 months, because it's going to depend on stimulus or lack thereof. It's going to depend on some of the how kind of disorderly some of the election contestation might become, and possibly how the pandemic kind of affects us this winter.
Definitely. Did you want to outline for our viewers maybe the top 3 reasons you're bullish on gold long term?
Yeah, so I mean, my core model takes into account 2 main things. One is the growth of the broad money supply over time. So if you look over the long term, the amount of gold per person in the world tends to be pretty static, right? So we have very, very small kind of increases in the amount of gold in the world due to mining, and we have a very slow increase in population. And so roughly there's about the same amount of gold in the world per person, whereas if you look at fiat currencies over time, there's a lot more units of those fiat currencies per person over a 5-year, 10-year, 20-year, 50-year period. And so over the very long run, gold actually tends to grow roughly in line with that rate of fiat currency increase. Or another way to put it is that fiat currency decreases relative to gold at roughly the rate that they're increased per capita. But there are a couple of things that can kind of make it deviate from that trend. And real interest rates are the main thing. So when real interest rates are positive, meaning that the yield you can get on your bank accounts or your treasuries compared to inflation, when that's positive, there's basically an opportunity cost for holding gold, which has no yield and has storage and safety costs. Whereas when you're in an environment where the interest rates you're getting on those assets are failing to keep up with inflation, you have a negative real yield, suddenly that, kind of scarce yieldless asset looks a lot more attractive. And so the big spikes we've had in gold tend to be during periods where we have negative real yields. And the big kind of downward moves in gold tend to be during periods of high real yields. And so we go along that trend of increasing money supply. So, if you look at the long term here going forward, I still expect money supply to go up pretty substantially over the next, call it 5 years, while real interest rates are likely to remain negative, which tend to be a pretty favorable backdrop for, gold, potentially silver, and some other commodities as well.
And earlier you were mentioning inflation, and I wanted to touch on that because it's really interesting because after 2008, we saw a huge increase in the money supply, but we didn't see a lot of inflation. And you've touched on this before, how actually now is the time we're probably going to be seeing inflation. And if you want to kind of unpack that for our viewers, why it's not necessarily just the increase of the money supply that matters.
Yeah, so it's a couple things. So if you look at 2008, for example, the increase in money supply was moderate. We actually saw a pretty rapid increase in kind of the behind the scenes money supply. So bank reserves, we saw a big kind of bank recapitalization program happening, whereas broad money supply that's available to the public, it increased moderately, but it didn't increase rapidly. However, here in 2020, we saw a much more rapid increase of the broad money supply. And that's because the QE that we saw this year was not just to recapitalize banks, it was mostly to fund government deficit, stimulus spending, which got that money out into the economy via stimulus checks, unemployment benefits, PPP loans that turn into grants, corporate bailouts, and other things like that. So we've actually seen a really sharp increase in broad money supply. Now, there's a couple pressures that push down on that. So we have, for example, very high debt levels are deflationary. Outsourcing is deflationary. Technology increases are deflationary. Demographics, aging, slowing population is deflationary. So at the current time, we have very weak money velocity. So even though the money supply is increasing rapidly, it's not circulating very quickly in the economy, and it's kind of coalescing. So if you go back to inflation, there are a couple different definitions for it. So of course there's monetary inflation, which is just purely measuring the money supply and watching that expand very rapidly, especially on a per capita basis. Then there's asset price inflation. So there's inflation in things that wealthy investors tend to buy, such as it could be, of course, be stocks and bonds and real estate, but it can also be things like gold and fine art and wine and things like that. We've seen a lot of that over the past decade, and that's because it doesn't really require velocity to increase as long as money supply is going up and it's kind of coalescing, and call it the top 5%. They put their money somewhere and they tend to put it into these assets that store value. Now, the last type of inflation would be consumer price inflation, which is when you see a broad increase in the prices of goods. And, it's kind of debatable if we've seen that. According to the official measures, we've not really seen that yet. Over the past decade, it's been very slow. However, some of those kind of baskets of good might understate inflation in some ways, especially, if you look at the healthcare sector or really kind of any service that can't be outsourced and kind of made cheaper in that way. So we've seen kind of a mixed bag depending on what section of that you're looking at it and how you're measuring it. But it's clearly been less than the growth in the money supply or the growth in asset price inflation. But if they keep up their current pace, I think they're increasing the possibility that they're going to find consumer price inflation, maybe not this year or next year because we're still kind of working through a pandemic and we don't have a lot of velocity. But when you look out kind of, the next kind of 5 years, I think that's kind of back on the table as a pretty significant option.
And this inflation, obviously, is one of the reasons to be bullish on gold. You've also talked about Bitcoin and cryptocurrencies in the past. What is your perspective on maybe how inflation could impact those different, forms of money?
Sure. Yeah. So I'm specifically bullish on Bitcoin. And so, I first covered it back in 2017, and I took a kind of neutral to bearish position. So that was during that big run up that Bitcoin had in 2017. And I covered it in the autumn when it was rising pretty rapidly because I got a lot of questions from my readers about it. So I was kind of forced to cover it. And I basically said, the sentiment is very high. There are a couple different ways to evaluate it. The technology is interesting. However, it's hard to justify the prices here at the moment. So I took no position. And I kind of had that neutral to bearish outlook. And of course, we saw, later in the year, we had that very brief spike, and then we saw a pretty sharp collapse. And so we actually had like a roughly 2.5-year consolidation where Bitcoin just kind of is volatile in this big band. However, in April of this year, I did become bullish on it at roughly the same price that I was neutral to bearish on it 2.5 years ago. So, it did underperform for that time frame, but here in 2020, a lot of things are more favorable. So, for example, back in 2017, Bitcoin is being challenged by other cryptocurrencies. We were seeing kind of hard forks between Bitcoin and Bitcoin Cash, kind of different, directions that it could have gone in terms of the technology and kind of the trade-offs that it makes between security and decentralization and scalability. However, in 2020, a lot of those debates are settled. Bitcoin's very solid. It's regaining market share among cryptocurrencies. The macro backdrop is more favorable with such rapid increases in the money supply and negative real yields. And so, for a variety of reasons, I became bullish on Bitcoin. Roughly just under 7,000 per Bitcoin And I still think it has a pretty good rate of run probably in 2021. It's a smaller market cap than gold. It has some advantages and disadvantages. One of the advantages that it's highly portable in the sense that, if you try to bring gold internationally, you're probably going to get stopped in an airport, whereas Bitcoin is a much more kind of optimized for that kind of international movement. We've seen, for example, if you're a Turkish citizen, your currency is very weak this year. You have more of an incentive to put it into things like Bitcoin, things that are highly accessible. And as that kind of plays out, as we see where it is in the halving cycle as well. So, for example, the number of Bitcoins that are produced every 10 minutes went down starting in May. So if demand remains consistent, you tend to see that it's almost like a short squeeze, right? So if you have a stock with a very low float and more investors are piling in, you can see a pretty rapid increase in that stock just because, buyers outweigh sellers. And so I think we're seeing that kind of play out in Bitcoin, and I continue to be pretty bullish on it. You just have to manage your position sizes because it's a pretty risky asset.
Definitely. Well, Lyn Alden, thank you so much for joining us today. Before we let you go, any last thoughts you'd like to leave with our viewers, and where can people find your work online?
I think that pretty much covers it. I would focus. We'll see what happens in the election. We'll see how it gets settled because it's still kind of in that somewhat unclear period. And I would just focus on there's kind of a room between diversification and diversification, right? So some investors kind of pile too heavy into say only like in the gold miners or only in a couple of things like that. Whereas other people, they just go the pure index fund route. They own everything. And I think there's kind of a middle ground where you can pick a handful of sectors, a handful of stocks, and a couple of different asset classes that you think have good favorable returns. So you're not taking too much kind of concentrated risk, but you have some degree of diversification. And so that's kind of the strategy I'm focusing on. I'm at lyndalden.com. And I'm also on Twitter at Lyn Alden Contact. So I have a bunch of free materials as well as a newsletter.
Awesome. Lyn Alden, thank you so much for your time, and God bless.
Yep. Thanks for having me.